Hi, everybody. Very good morning to you. I know we've got a lot to get through today, so in the interest of time, we're going to make a start. So thank you very much for joining us this morning for this K3 Hub CPD session. My name is Marie Wadeson, and I'm a Managing Director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. K3 Capital Group offers a wide range of niche advisory services, including restructuring, corporate finance, disputes, investigations, evaluations, R&D tax credits, tax advisory, and marketing and business development advisory services for professional services firms. Just before I introduce you to our speaker today, I just thought I'd run through a few pieces of housekeeping. So as you've seen, as you've hopefully seen, as you've entered the Zoom room, as I commonly call it, you will see that we are recording today. This session's recording will be placed on both the K3 Hub and Quantuma's websites in the week ahead. Q&A function is open, so do feel free to ask questions as we go along. If you wouldn't mind using Q&A function to ask your questions rather than using the chat, it just means that we've got everything in one place, and that would be super helpful for our speaker. We anticipate that we'll have quite a lot of questions today, and we may not be able to get through all of them. If that's the case, then what we'll do is we'll ask our speaker today to respond to you separately via email after the webinar. We are aware that this is quite a long session this morning. I think we're running for about 3 hours. So we are going to plan to take a couple of comfort breaks. They'll be there or thereabouts on the hour. A couple of polls. I think we are running some polls this morning. Actually, the team in the background have informed me. So they are anonymous and just for fun. So please do get involved. Right, so I'll move on to today's webinar then in that case. So I am very pleased to be able to welcome back Jeremy Mindell. I was just chatting to Jeremy before we opened up the webinar this morning. I did say to him that he's one of our most popular speakers and has been for a very long time here at Quantuma and also at the K3 Hub. So Jeremy, just to cover off who Jeremy is and what he does. So Jeremy runs webinars and in-person events for us, and his tax sessions are extremely popular. Jeremy has been lecturing in taxation for over 20 years. He also covers issues related to pensions, share schemes and remuneration, and he's also one of the very few individuals in the country who is a qualified tax advisor, chartered tax advisor indeed, and also holds a certificate from the CPD. Today, Jeremy will cover a number of areas that non-tax specialists should be aware of, which include the differences between capital and revenue and employed versus self-employed, computations of losses and profits, and also international tax. Just before I hand over to Jeremy, just a couple of words about some forthcoming K3 Hub events. We do have a packed schedule of CPD and training webinars this year. Some of our forthcoming topics include understanding the accounting requirements of LLPs, VAT, a LinkedIn masterclass, which is very popular with our members, commercial property taxes, another very popular course, and the ever popular autumn statement. Invitations are sent out on a regular basis, so do keep an eye on your inbox. We also promote the events on the K3 Hub website and the Quantuma website, as well as on LinkedIn. So do keep your eyes peeled for those. I hope you enjoyed today's session, and I wish you a great weekend when it arrives. Jeremy, over to you.
Thank you very much indeed, Marie. Good morning, everybody. I will, without any further ado, we've got a lot to talk about. So, as Marie said, session concentrates on the areas of tax where there's an interaction between taxation and different disciplines and specialisms is essential. So this is more, unlike the other courses which go into more detail on a specific subject, whether it's commercial property or VAT, this one is looking at an overview, but also the interaction between different departments and explores the consequences of the decisions made in other areas on taxation. Also, the compliance and reporting obligations are shared between the tax department and other parts of the business. I'm going to look at some recent events, structuring your business, national insurance, capital versus revenue, employed versus self-employed, all of which have become a greater issue as a result of recent budget changes and recent changes in legislation, as well as practice. Capital allowances, computation of losses and profits, Research and development, I'm going to look at because there's been quite a lot of discussion about that. And then international aspects, including transfer pricing. So the first element that I think is actually quite important is revisiting the idea about whether businesses should set up as sole traders, unincorporated businesses, where there is just a relationship between the trader and the customer, and the trader is taxed on the profits that they make. And the alternative, which is that you have a company, you incorporate, and you interpose a company between yourself and the customer and the supplier. And those two forms of business have been around for a very, very long time. The point would be, already a question. Are there any slide notes? Sorry. Yes. So the question would be that when you're looking at the two types of structures, there's a lot of discussion for businesses. Should they operate as a sole trader, a partnership, or a company? And for a good number of years, what we were looking at was that operating through a company seemed to be more beneficial, whether it was low rates of corporation tax, low rates of dividend tax, low rates of and the high rates of national insurance contributions meant that operating through a company had some significant advantages. And also in certain areas, such as because of the IR35 rules, where a company could become responsible for tax deductions unwittingly for people who were really employees, organizations as diverse as the BBC and the banks would insist on service providers operating through companies to protect themselves against a tax on that basis. But in recent times, that has become less attractive. And as I'll show you from a tax and national insurance point of view, operating through companies become less attractive for smaller businesses. There are more costs. And as you'll see, it's an area which I think businesses need to think about quite carefully because of the regulatory and tax pressures on companies, which have certainly not been eased in the last budget. In essence, when we're looking at the tax position, what you're looking at there is a situation where if you operate through a company, you'll need to do the corporation tax and any associated returns, annual returns, accounts, and so on. The other elements you would probably need to do irrespective of whether you're in a company or other format, and that includes business rates if you operate on a premises, business premises, income tax and national insurance. The difference is that an unincorporated business, you're taxed on the profits, whereas an incorporated business, you're taxed on what the company gives you. And then, of course, VAT based on a £90,000 threshold, and that is on turnover of the business, irrespective of whether it's through a company or not. In terms of determining whether you are better off being incorporated by a director of a company or self-employed, there are lots of moving parts in the calculations, which means that everybody's calculation is a bit different. NIC rates, class 1, national insurance contributions. So class 1 consists for the employer-employee, employer going up to 15% next month, employee remaining at 8%. But class 4, which is the self-employed, remains at a record low figure since it was introduced in 1978. It's now at 6%, which is lower than when it was first introduced in 1978, when it was 6.3%. Corporation tax rate. So for a lot of companies with profits over £50,000, they have a marginal rate, which could be as high as 26.5%. And for larger companies, CT's at 25%. It's only for companies with profits of £50,000 and below that you've got a rate of 19%. Dividend rates, well, they've gone up since 2016 a couple of times, and those increases in dividend rates have not been reversed, unlike the increases in national insurance. Income tax rates have remained fairly steady. It's only the thresholds which have been either frozen in the case of the higher rate threshold, or actually reduced in the case of the additional rate 45% threshold. And then the other element, which is very important, is how much of the business money, the profits that you make, do you want reinvested in the business? And how much money are you taking? If you're basically taking all the profits out, then quite often being a sole trader or partnership would be better. If you're leaving money in the business and basically deferring the higher rates of income tax, then running as a business would seem a good idea. And it's that last point that sometimes overrides all the calculations that I'll look at. So incorporate or not incorporate. So if you incorporate, you have potentially a limited liability. But something that I'm sure that the reconstruction specialist of consumer could tell you is that limited liability protection is broken on a number of occasions, particularly when directors do things that perhaps they shouldn't, like underpay their taxes or the company's taxes, or indeed pay dividends that are not justified. Typically, liquidators look at the conduct of directors over the last 3 years, including their tax record. And if there's a shortfall, quite often directors have to stump up the difference. HMRC issues things such as personal liability notices. And I always say to people that they do need to be careful, because quite often what they're collecting is money which is not their own. So if you think about VAT, you're collecting it from customers and paying it to HMRC. HMRC, not unreasonably, says, well, it's our money and you shouldn't be using it for another purpose. And if you do and you don't pay us, then you are personally responsible. Then there's the issue of credibility. Some people think operating through companies is more credible. It is a separate legal entity, so persuading people that the money is not their own to do as they please, even if they own 100% of the share capital, is important. Or at least they can take the money from the business, but they're likely to have to report it and pay tax on it. Then you look at elements such as annual returns, which need to be done to Companies House. And indeed, they are increasing the disclosure requirements of companies to include profit and loss accounts. The corporation tax that needs to be done and paid, the pay as you earn, even on directors. Directors are sometimes surprised that they actually have to pay as you earn. And the dividends, that offers opportunities to spread wealth. So that's an advantage. Obviously, you're unincorporated, then you're fully liable for anything that happens in the company, in the business, I should say, not the company, the business, including, if there are debts that need to be paid, they're personal on you. You'll be taxed on the profits, which means that potentially unable, if, suddenly customers pay you, to avoid high marginal rates of tax when you may not need the money. Or you want to reinvest it in the business. So something that you need to think about, that the taxation on profits, if you're unincorporated, can lead to unintended consequences. From a cash flow point of view, there's a sort of catch up that the tax is relatively late in arrears. You wait quite some time before you have to pay. And then there are effectively catch up payments as the business matures. There is less returns and less paperwork. You pay tax twice a year, in January and July, and you can claim tax relief on losses. What's important about that is that if you're unincorporated, you can normally, and you make losses, you can set them in what is known as sideways relief against other income that you have. And indeed, for the first 4 years of the business, you can set against income you had in the 3 years before the business started. And that means that for loss-making businesses, it makes quite a lot of sense, if they can, to be unincorporated for a number of years before they get going and start making significant profits. In terms of a business, you start with an idea. You normally have to do a business plan and a cash flow, particularly if you're looking to get outside investors, either people who lend you money in the form of loans like banks and other institutions, or in terms of investment in the equity of the business, and that element also will need a business plan. And of course, what is really important is a cash flow. As again, I'm sure the experts from consumer will tell you that more businesses run into difficulties because of cash flow than the underlying profitability. They may be a profitable business, but then something doesn't get paid on time and they end up in cash flow difficulties. And that something could include unbudgeted for, unforecast taxes. In terms of the tax process itself, you need to notify HMRC of your business existence, register for VAT if your turnover is above £90,000, and if you're a company, you're going to have to register for corporation tax. The tax process also includes that if you are paying yourself as a company or paying others in a business, or both, then register as an employer, register for national insurance, and if you've got money coming in, probably a registration for self-assessment as well. The good news is that HMRC has made this easier. You go on the website, HMRC website, and you register for HMRC taxes. And that includes, one-stop shop for self-assessment, corporation tax if necessary, pay as you earn for employers, and VAT. If you've already registered and suddenly you're above the VAT threshold, then you need to register separately for VAT. But if you could at the start do a one-stop shop and do it all, but you may not want to register for VAT until you hit the relevant turnover limits. And it's a form which is intuitive. In other words, it goes from one to another, asking questions on that basis. And you then do the next button. It's not difficult to do, but it's amazing how many people forget to do it. And suddenly they're already in catch-up mode and they're really on the defensive when it comes to their taxes on that basis. So an important starting point. Then the next thing people always ask me is what sort of deductions can they get, which may actually obviously wipe out their income and indeed create losses. Well, for normal small businesses, quite often operating from home these days, there's the office in home deductions. There could be, and we'll talk about those a bit later, the use of a car or van, use of utilities, stationery, subsistence, website development is an obvious one, marketing, telephone, and travel. And it doesn't matter which mode of travel you use or which class of travel, if it is for the use of the business, then you can claim it. Then we can look at some important figures for 24-25. So personal allowance frozen, I think until 2028 now at £12,570, which means, of course, you can pay up to somebody £1,000 a month and they're not going to pay any income tax or national insurance on it. You may pay employers NIC, but they're not going to pay anything else. They would get the money gross. The issue you've got is, particularly when paying family members, you do need to make sure that you justify what they are doing on that basis, because if you can't justify it, then HMRC can disallow the expenses. Child benefit phase down. So important to note, it's been in the news quite a lot over the years. At £60,000 now, you get the full child benefit. At £80,000, you get none. And your marginal rate of tax, the amount of loss you have, depends on the number of children you have. So you lose it as you go through on a straight basis. But the more children you have for child benefit, the bigger the marginal rate of tax. The additional rate threshold starts at £125,140. I looked at something on AI recently and it managed to get it wrong and still had it at £150,000. It hasn't been that for nearly 2 years, which merely shows that you do need to be careful when you are using AI, because it's not always up to date. Basic rate of tax, same as it's been for over 2 decades, is at 20%. Class 2 national insurance, £3.45. Class 4 is at 6%. And the previous government effectively reduced it, went up to 10 from 9, and then went down to 8, and then down to 6. And the current government has not changed either the employee NI or the class 4. And this has an effect when you're considering a company versus a self-employed structure. Corporation tax rate, as I said, up to 50,000 is 19%. You then have a rate of 25%, but because you phase out the £3,000 small profits relief benefit, effectively between 50,000 and 250,000, you're paying at 26.5%. So if you did a computation of, say, I've got a profit of £100,000, the first 50,000 is at 19%, and then the balance would be at 26.5% because you get a phase down of the small profits relief. The maximum value of that is 6% on 50,000, £3,000, and that is phased out as the profits move between 50,000 and 250,000. What that means is if you've got profit, say, sitting at 100,000 and you decide to put 50,000 into a pension scheme, you're actually saving tax at 26.5%, not 25 or 19% on that slice of saving where bringing the profits down to £50,000. Class 1 employer is 13.8%, and as we know, going up to 15% for 25-26. What is perhaps more of an issue is the reduction in the threshold for employer NI from £9,100 to £5,000, which may have a devastating effect on businesses in hospitality, care and so on, which employ relatively low paid casual staff and are finding a huge increase in their costs. And then class 1 employee, which remains at 8%. Let's me look if there's a question. If company A with one shareholder and director have a large amount of cash, and company P, which is a special purpose vehicle, and same shareholder and director want to use the funds from company A, does company A need to declare a dividend, or can it lend the company money to company B on commercial terms? And the answer is yes, they can definitely lend on commercial terms. It would be useful to put in the Articles of Association that one of the elements, one of the activities of Company A would be to lend money. And the reason for that would be then you can justify holding more cash balances without it being seen as an excluded asset and therefore not, imperiling potentially some of the tax reliefs on that cash. So yes, they can certainly do that. Yes, they should charge a commercial rate. And but I would also say that they should put in the articles that that's one of the activities that the company can do, which is be a source of finance to other members of the group. Hope that answers that question. Thank you for the question. I'll just check in the chat box if any questions come in. No, good. Oh, not good. No, I'm quite happy to have questions, but they should be as was put in the question and answer bit. So yes, definitely you can lend money. A reminder of what is taxable income. So money from the sale of goods is income, money from the sale of services income, money from sale of licenses and image rights, normally income, and interest received would be taxable income. So, an example before, if I lend money and I receive interest, the company paying the interest would normally get a deduction. The company receiving the interest would normally declare its taxable income. What is not taxable income is loans, or loans is not itself income, and it's not deductible on the other side. The interest might be, but not the principal. Gifts for no consideration. So let's say I start a business and family member gives me money to start the business. That is not taxable income. And investment into the business is not taxable income per se either. There was a question. Let me see. Is it better to convert self-assessment to companies in order to be away from the hassle of MTD? No, it's not, because MTD, making tax digital, or as I call it, making tax difficult, applies to businesses. So actually, funny enough, businesses are going to be hit first before there's MTD for corporate tax. So there's MTD for income tax coming in 2026. MTD for corporation tax is supposed to come 2 years later. I think that MTD is a bit like a visit to the dentist. I do apologize if I've got some dentists on this course, but it's not something that I often look forward to, even though my dentist is very good. But quite often the fear is worse than the actuality. I think with MTD, it may actually be quite a good discipline in terms of forcing people to do their records and get things right on time, rather than catching up sometime after the event. So I would say this is not a particularly a good reason for going for a company. And of course, you get a lot more hassle from, all the elements that companies need to do. Remember, you need to comply with the Companies Act 2006, which is one of the largest pieces of legislation that Parliament ever passed. And the burdens of being a company director only seem to get greater rather than less. But a good question. Thank you very much. So taking on staff, you've got employees, you've got responsibilities. Under the employment bill, those responsibilities like to go up. And if they're self-employed, you're going to look at things such as, do they provide their own equipment? Do they advertise for their own services? Are they in business on their own account? Do they negotiate rates? And do they have discretion over taking work? That's important. That's known as sort of mutuality of obligation, and is key in that area, determining employment versus self-employment. In other words, an employee needs to turn up for work, unless they're working from home, and needs to take reasonable instructions from the employer, and the employer needs to provide them with work on that basis. Now, for historic reasons, and even though I've had some advantage from it, I'm not convinced that the differential in treatment between employed and self-employed is totally justified. This may be a minority view, but it's fair to say that being self-employed has advantages which have increased under the current government and the previous government rather than decreased. And therefore, HMRC is quite keen to police this area and ensure that if people are self-employed, they are genuinely self-employed. And if they've got independent companies, they genuinely are in independent companies. And there are lots of cases going through the courts on this. What I'd like to do is just take a moment and let's get the first poll up, please. And the first poll just says which areas you actually work in. So can we get the first poll up, please? And if you can just fill in something on that basis. I'm just going to shut the window because it's suddenly got very cold. Give you about 30 seconds. Oh, it shouldn't take you terribly long to work this through. So about another 10 seconds. Then let's get the results of the poll, if we can. Oh, what's going on here? Tax, small number. Law, audit, only one person has volunteered there in law. Entrepreneur couple, but the vast number are in accounting, second law, and then tax. No one in company sector and only one person in HR. Okay. If I look at taxes that people worry about, I think the big ones are income tax, for obvious reasons, capital gains tax, particularly because the rules are changing and it seems to be more of an issue now, particularly with the annual exemption on capital gains tax moving from a relatively generous £12,300 to a miserable £3,000. This has become quite a big issue. Corporation tax, you pay CT on profits from £1. National insurance, interesting elements about NI, and of course, as a major revenue raiser. And then the other biggie one that people worry about is a small tax in terms of it only raises about 8 billion out of 850 odd billion, I think that Jim Harris said last night was raised by HMRC. And, but it don't half upset people, IHT. So can we get the second poll about which tax you are most concerned about? Give you a little bit of time to answer the question. Okay, let's see the answers. Oh, now it's quite interesting. In that top, but only just top, is income tax, followed by inheritance tax, then CGT, then national insurance, and then corporation tax. And the interesting element from that is that if you think of the big three that raise money, they are income tax, followed by national insurance, and then followed by VAT on there. Inheritance tax, as I pointed out, raises a very small amount of money relative to anything else, but it is a major concern for a lot of people. And it's quite interesting that no government has, governments 2007 to 10, both the Labour government and the Conservative opposition courted popularity by promising to reduce IHT. But since then, IHT has generally, there was the introduction of the residential nil rate ban for residences. But apart from that, IHT is, particularly with this government, gone only one way, increased in its scope and reduced allowances. Let's look at NICs, which are the second biggest revenue raisers. So less than income tax, but more than VAT. And then those three are in the Premier League of taxes. And the others are sort of also rans, although corporation tax would probably get into the championship these days at about 80 billion. And then you've got some going right down to what I would consider what used to be called the Rothmans Isthmian League, with some taxes collecting very little money indeed, but causing a lot of hassle. I put in a sort of at a restaurant because they will be disproportionately hit by these NIC changes. If you look at employers NIC going from 13.8% to 15%, and as I said, the big killer, I think, on this, and the thing that I think was, how can I say, courageous, I think, in the terms of, yes, Minister, secondary NIC threshold reduced to £5,000 from £9,100 from next month on that basis. The cost per employee just of the threshold changes £615 on that basis. The employment allowance, where you need 2 people earning, is increased from £5,000 to 10,500 from 6th of April 2025, and that will cover class 1 employees' contributions for a business, and £100,000 maximum pay as you earn limit is removed, so that from next year larger employers can now benefit from the employment allowance, which I thought is rather strange. I can't see that the likes of Shell and BP and all those multinationals are really that bothered about the employment allowance. It really is, not a huge element for them. So I was wondering about it. Companies with only 1 person on the payroll will remain ineligible for the employment allowance. The other NIC changes on that basis: the small profits threshold, below which voluntary contributions must be paid to preserve the entitlement to contributory state pension benefits, increases to 6,845. Now, Martin Lewis has managed to get, again, the proverbial telephone ringing off the hook for HMRC, as he's publicized the fact that, you've got less than a month to do the voluntary NIC, going back to, I think, 2005-6. So going back probably 20 years to ensure that you maximize your state pension. Remember, you need 35 years of contribution or credit to get a state pension. Class 2 NICs going up to £3.50. Class 3 NICs, £17.75. And you think that's the voluntary element. Why do I pay voluntary elements? Well, in order to keep my entitlement to benefits. And this is the interesting element: no changes to class 4 NICs rates or thresholds. So before I take an example, let's have a look at the Q&A. Oh, a big one here. If the spouse of a sole trader works primarily as a contractor in the sole trader's business for, say, 3 years, there is a risk that HMRC will determine that the spouse is not a self-employed contractor and should be taxed as an employee of the sole trader. However, the spouse has other business income that can show the spouse to be properly working on a self-employed business. My question is, how much other income apart from the spouse's business should the spouse have to demonstrate to HMRC that they have a genuinely self-employed business? Should it be 10, 20, 30% of the non-spouse income? Now, my answer to that would have been, before the Adrian Charles Basic Broadcasting case went to the Court of Appeal, that you could look at a percentage of income that's derived from elsewhere as helping with self-employment. But what the Court of Appeal said is, effectively, you've got to look at each engagement on its own merits. And just because I'm doing other work elsewhere doesn't mean that I am genuinely self-employed in this engagement. So I could be an employee 2-3 days a week and have self-employment the rest of the time. And clearly, if I'm working for the husband, the likelihood is, and I've been working for 3 years and it's just carrying on, I would say the likelihood is you would have to look at the nature of the services, but it's much more likely to be deemed as an employee because of the nature of the services that the person is doing. I think it's very difficult to say that there's a sufficient distance of relationship that they're likely to be self-employed. It's not impossible, but I think it's a bit of an ask to say that they're sufficiently independent, that they're actually providing services on a self-employed basis. That would be my answer. And I think that's reinforced by the fact that you look at the individual engagement. What is it? And to a certain extent, you ignore the fact that you've got lots of different engagements. Hope that answers the question, David. And the next question is, can you get employment allowance with 2 directors only on the payroll? Yes, if they both have, I think, above the NI threshold, then you can do so. But we're coming up to March. Do check that and check the payments if you think you're not qualifying for employment allowance and you need, so I would check that, but you can have 2 directors. Another question? No? Chat box. Will I be looking at capital allowances for cars, vans? I will briefly look at that in terms of capital allowances, but only relatively briefly. Basically, with cars and vans, if the vehicle is not primarily adapted for the carriage of goods, then it's going to be seen as a car. If you look at the Vauxhall Vivaro, it's the Coca-Cola case. If you look at Vauxhall Vivaros and VW Combis, they were both, although they could be used for goods or people, because they could be used for both. On that basis, they were seen as cars and therefore got less tax advantages. Hope that answers the question. Okay, let me take a couple of examples here. So, example 1, and it looks at employed versus self-employed. Profit before any director withdrawals 30,000. Director takes that 12,570 of salary and posts CT profits as dividends. Assume no employment allowance available. Remember all the moving parts, and the director's other income is negligible. And remember that the dividend allowance is now only £500 when it used to be, back in 2016, £5,000. The profit before any directors withdrawals on that basis, 30,000. How will that affect matters? Well, Class 1 employers NIC under the new regime will be 12,570 minus 5,000 at 15%. So that's quite a hefty amount for a relatively small amount of salary, £1,136. The deduction that the company can get for CT is is effectively the wages that are paid, 12,570, plus the employer's NIC, which is the cost of the company, 13,706. The CT paid by the company is 30,000 minus 13,706 at 19%, which is £3,096. The profits available for distribution are 30,000 minus the salary I've already taken, minus the employer's NIC, minus the corporation tax paid. So you're doing quite a lot of calculations, which is where the fees start to rack up, which is £13,198. Then that isn't the end of the story. I take this all as dividends. I'm going to end up with the dividends that I can take, the distributable profits of 13,198, less the £500 at 8.75%, in the £500 dividend nil rate band, which is £1,111. Cash in hand is 12,570. Plus, so how much cash as a director am I having in my pocket? The salary of 12,570, the dividend of 13,198 minus the tax on the dividends of £1,111, which is 24,657. And therefore the overall tax cost, easy to work out, is 30,000 minus what I keep in my pocket, 24,657, is 5,343. What if the director was self-employed instead? And you can see that the calculations are easier, which sort of gives you a hint that the paperwork is easier. You've got the income tax plus class 4 NICs on 30,000 profits is 30,000 minus 12,570 at 26% is £4,532. The cash in hand would be 30,000 minus 4,532, which is 25,468. And for the director beforehand, it was 24,657. So what we're looking at is, by being self-employed, before you get any additional, take into account the additional fees of running the company, you are effectively about £800 better off if you had a profit of 30,000 of being self-employed. Let's look at example 2 with a much higher figure. Profit before any director withdrawals of £150,000. Director takes 12,570 of salary and pays CT profits as dividends. Assume no employment allowance available and that the director's other income is negligible. So here the salary of 12,570, post CT profits as dividends. The class 1 employers NIC payable are 12,570 minus 5,000 at 15%, which is £1,136. The total deductible for CT for the company is 12,570 plus the 1,136 is 13,706. Taxable profit on that basis is £136,294. So we're talking there about a profit which is a lot higher than the small profits rate of limit of 50,000. So therefore you're in the marginal rate of 26.5%. And that obviously means that the CT jumps substantially and is £32,368. So the profits available for distribution there are 150,000 minus the salary you've taken of 12,570 minus the class 1 employees NIC of 1,136 minus the CT payable. So I've got 103,926, which is payable or profits, which I could take as a dividend. Now, generally speaking, what's the point of having a company if I take the whole profit as a dividend? Unless it's, a particular year that I suddenly need the money for a non-tax reason. But for a tax reason, one of the advantages of companies is that I could say, I'm not going to take all the income. I don't want to fall into the 60% band where there's the phase out of the personal allowance, which is exactly what happens here, in that if I take the money fully distributed, I end up with total income of 116,496. When I go above 100,000, for every £2 of income, I lose £1 of personal allowance, which means that I end up losing £8,248 worth of my personal allowance. Comes down to £4,322. What that means is that even though I'm paying myself 12,570, I've got income tax on my salary because I've only got 4,322 of my income of the abatement of the personal allowance left. It's been reduced by 8,248. That's at 20%. So I'm going to pay 1,650. Then at the basic low, fairly low rate of tax on dividends, there's £500 on which I don't pay a tax on the dividends at all. So I save 8.75%. But there's 8,248. So my basic rate band is reduced by 8,248, which means I pay less at the basic rate, 2,533, but I pay more at the higher rate of 33.75% of 25,135. So on the top amount of income, I'm paying at 60%. So I'm paying effectively income tax on dividends of £27,668. My cash in hand after I've taken off, when I sort of look at my salary, my divs, take off the tax on the salary and the tax on the divs, is 87,178. Keep an eye on that figure. The overall tax cost, once I include also the corporation tax, is 62, and the employees NIC is £62,822. What happens if the director was self-employed? Well, number one, it's a simpler calculation. It's just basic rate, no personal allowance, because they're well above the cutoff there where you lose the whole personal allowance. But you've got 37,700 at 20%. Then you've got the up to 125,140 at 40%. And then you've got the balance of 45%, so 53,703. The big savings on class 4 NIC, where I still don't pay class 4 NIC on the first 12,570, is then only 6% up to the upper earnings limit. And then it goes down to 2%. So it's only £40,257. My cash in hand, once I've taken off the income tax and the national insurance, is 92,040. So at £150,000, I'm £5,000 better off being self-employed. And this sort of summarizes the position, where in most cases there is a sort of hiatus at around, what is it, 650, £60,000, where you're better off in a company with a personal allowance and employment allowance. But generally speaking, you are better off as a sole trader. And as your profits go up, so if you look at, profits of 240,000, I mean, the difference is stark. It's around 13 odd £1,000. Something certainly to think about. Let me take, have there been any questions here? Question. If the company has no employees, all pay as you earn or VAT, registered for a service business, and the sole director and shareholder does not take a salary and has income from investments covering the personal tax threshold, and the business is making less than the director's pension cap per year of 60,000, so puts annually into the pension pot. In light of the new tax rules on pensions, what's the best strategy going forward? Oh my goodness. Sorry. That has so many parts to the question, Raina. I think the point would be that the issue is going to be that they need to think about, well, what do they want to do with their pension? If they're saving, if they were using it as an IHT vehicle, then you might want to think hard about what you're going to do if the government goes ahead with the current proposals in 2027. Now, given the facts, as I was explaining to Jim Harrer, you could end up with a rate of an effective combined rate on IHT and the pension of somewhere in the order of 84%. I think that may get revised before 2027. So my thought would be is I would hold fire. Don't do anything rash at this point. You, of course, haven't told me what the age of the individuals are, so they may, not take the pension until there've been lots of different changes. I think at this point you have to gather information about intentions, the money in the pot, what they're looking to do, and how the business is likely to proceed, and get that information in before anything else. Well, at age 53, they might have quite a long time before they're taking their pension, and therefore at that point, they might, that would be a different element. If they're looking to take it immediately at 57, that's a different strategy to taking it, in their 60s or 70s. Hope that answers the question. If you want to send anything to me, you can email me on that, because that has a lot of moving parts and considerations to that. There isn't one answer that would satisfy everyone. That's a good example of where you would want absolutely specific advice on that basis. Okay, we've got 5 minutes to the coffee break. Let me look briefly at employment versus self-employment. And in terms of, there has been a sort of significant trends conversion in terms of the self-employed and employed have work patterns and benefits which have sort of merged with the employed. And even in terms of flexibility, you're seeing much more flexibility in employment than you were seeing before. Employment costs are quite high. You've got pension auto-enrollment, the apprentice levy, although that is likely to be changed, that is for companies which have fairly substantial payrolls, but it's an area to think about. Holiday based on expanded definition of earnings. That's not a tax issue, that's an HR one. And employer NI 15% uncapped. In terms of self-employed, you've got rights in the contract for services, but they would be limited normally. Some health and safety on site, restrictions normally, no employer NIC, no apprentice levy, and no pay as you earn. Well, that's what you would hope. But you can see why that might become a problem. And that the convergence trends that I talked about just before have been used by HMRC to say, well, even if you've got flexibility, so have lots of companies now, and they're employment relationships. That is not a silver bullet to say that you are self-employed. Indeed, modern working patterns have blurred the distinction even further. If I pay £100,000, what's my risk? Well, and I don't subject it to pay as you earn as the employer or deemed employer, £40,000 of a tax, about 14,250 of employer NIC. You might have to pay the employee NIC as well, if you have failed to deduct it at the right time, plus interest and penalties. And we're looking at something around about the 70% mark, which could be at stake there. So whatever you pay, potentially, you could have to pay another 70% if you're found not to apply pay as you earn. And that's where, if you sort of the status questionnaires come in, and the sort of question that I had about, do I employ the spouse, or is the spouse self-employed? Where employment and tax are interlinked, so you look at recruitment, drafting of contracts, inducement payments. The contract is a significant document in determining whether you're employed or self-employed. Benefits, how are they structured? Are they employee type benefits? Do they go to the employee Christmas party? HMRC has been known to ask who went as part of a status inquiry. Transfers. Is it a secondment where your existing employment stays, or is it a new employment? In terms of sources of employment law, so when I look at it, if I'm looking at employment taxes, I'm looking at statutory instruments, which are secondary legislation. It means they're passed quickly, but they still have the force of law. Looking at statements of practice, which are non-statutory, which give a legitimate expectation that taxpayers can rely on them, but they're not statutory. HMRC manuals published online, HMRC booklets like 480 to do with expenses and 490 to do with travel and subsistence, and HMRC websites like Check Your Employment Status tool, which you can use to help you check whether somebody's employed or self-employed. There's a similar one for residency as well. In terms of sources of employment law, you would look at things like the Employment Rights Act of 1996, other statutes, and employment tribunal case law. We're going to take a 7-minute break now, and we're going to look at the general principles of employment status after the 7-minute tea break. Okay, let's carry on. So employment status, general principles that we're looking at. So if I look at employment status, it comes up often. And here we look at, how much control you have. The more control you have over an individual, the more what was quaintly known as the master-servant relationship in some of the classic cases, the more likely the person is to be an employee, and you the employer. Integration, are they integrated into the business? Is what they do an integral part of the business, or is it something that is sort of an appendix to the business, not an integral part of it? The risk, who's taking the risk? When you act as an employee, it's normally the company that takes the risk if something goes wrong rather than you. Pricing. So, you get a wage, and you doesn't vary from day to day or week to week or project to project. So pricing, whereas the self-employed will set their rates on that basis. Substitution of labor. A lot of people think that if you can substitute labor, that you can, send someone else to do your job, that you will be self-employed. The problem where it falls down is that quite often people try and say, well, we could substitute, get someone else to do the job, but actually they never do, and it would never work in practice. Use of capital. Am I using my own capital to run the business, or am I using the engagers, the other companies? Advertising. Do I advertise on my own behalf, or do I advertise on for my employer? What would be my employer? What is the status of the business? Do I employ people within my own business when I provide services? All of those are indicators on that basis. And then what you do is you examine the paperwork, you test against economic reality. You might want to use the HMRC checklists as a assess tool for that on that basis. Obviously, in terms of the structures, you've got the sole trader works directly for a client, and that's the simplest structure, and I'd argue is probably overlooked too often because of the tax privileges that you can get. For example, the ability to use losses against other income. And I think given the way that the world has gone in terms of legal, again, the company veil isn't as useful as it used to be, isn't as foolproof. You've got limited company providing worker for an end client. It could be a personal service company. Agency providing workers, companies providing workers via agencies, or overseas entities providing workers. If I look at them in terms of on the pay-as-you-earn NIC, if there's a sole trader working directly for a client, the risk lies with the end client as they have the obligation to operate pay-as-you-earn if the individual is an employee. It is, however, theoretically the most straightforward example. And there you've got a direct relationship. If I provide services as a sole trader, there's no company sitting in the middle, something I talked about at the beginning, and I would therefore, the risk is all with the end client. And that's why organizations like the BBC forced presenters to operate through companies. But of course, since 2021, that does not help them because the responsibility for large and medium companies in terms of IR35, i.e. the potential tax due if these individuals are seen as employees, has fallen back to the end user. And this is what we talk about in IR35. You need to consider, so it's a limited company providing services of a worker. And the idea is that the end user, except for small companies, is responsible for determining the status of the services provided through a personal service company. And therefore, on that basis, it's the end user that has to work out whether there is a deemed employment. And if there is, should they need to operate the IR35 payroll. An agency providing worker may fall within the agency legislation. Person contracting with the agency must be an individual. Individual renders personal service to another person, the client. The individual is subject to or to the right of supervision, direction, or control as to the manner of rendering such services. So if I have an agency and they provide me to a client in Hull, I can only get the travel and accommodation to Hull, generally speaking, if I am not subject to the supervision, direction, and control of the end user in Hull. If I am, then I'm treated like an employee on that basis. And under those rules, I would not be able to get the travel and subsistence allowances. So important to look at the SDC elements. And these rules have been tightened up over a period of time. Question. Are small company exemptions still in place for IR35 where the test's not made against small companies and consultants working with them? So in other words, if I'm a small company, right, then the exemption is that I don't have to consider people operating through a personal service company. But a small company would still be in scope if there's a direct relationship. So that's a small company would be one of the few occasions where they could say, well, we would prefer to work with other companies because it reduces our risk, because they have the same risk in terms of individuals working directly for them. HMRC could turn around and say, well, we think they're employees on that basis. So for small companies, if the services are provided to them through a personal service company, that does provide them with protection, which it doesn't provide to medium and large companies. And then for IT, the next question, which is from Will, for IT security, does providing phones and laptops, etc., to consultants, non-workers affect this IR35 determination? It would be one of the factors, but not the only one. For example, let's say I was working in a highly sensitive area. I might want individuals to use my phones and laptops because of security issues, say in the defense or cybersecurity areas. It would not be a determinative issue. And indeed, if there's a good reason for it rather than just a perk, I don't see that as a major point. I could ask everybody who appears at a site to go through some measure of control if it's a sensitive one, and there are good commercial reasons. And that wouldn't automatically put everybody into the employment position. Yes. Yes, I mean, that would be a good example of it. Limited company providing services to worker via an agency. So you've got to look at the agency regs. You also look at IR35 on that basis. And HMRC will also want to check to see that the contract is genuinely with the personal service company and the agency, not between the agency and the individual. In terms of overseas aspects, Finance Act 2014, so over 10 years ago, targeted anti-avoidance provisions aimed at, trying to route the money over offshore to try and avoid pay as you earn. And what it basically says is if a client gets lots of services via agencies which are conveniently offshore, then potentially HMRC can stick the liability with the client on that basis if they're based in the UK. So effectively, if no one's caught by the provision, you stick it on the UK element and tell them they're responsible for the operation of pay as you earn. Obviously, in terms of self-employment characteristics, having a look a little bit further, put in bids or give quotes to get work, not under direct supervision when working, submit invoices for the work they've done, responsible for paying their own national insurance and tax, don't get holiday or sick pay when they're not working, and operate under a contract, sometimes known as a contract for services or consultancy agreement that uses terms like self-employed consultant or an independent contractor. No single element is a silver bullet, as we'll talk about. A good example of that would be hospital surgeons. Now, there is, as people would know, the doctrine of clinical freedom, which says that once you're in the operating theatre or in the consulting room or wherever you are not subject to the control of the health authority in terms of you make clinical decisions. But even though you've got a significant measure of autonomy, you are still employed by the health authority. That's a good example. Whereas, for example, if you think about risk, if I'm on a commission-only double glazing salesman, then on that basis, I could still be employed on that basis. A contractor, if you name it, a contractor can be self-employed, work or an agency if they work for a client, they're employed by an agency, and there's a special scheme for self-employed contractors and subcontractors working in the construction industry, known as the construction industry scheme, that even if you're self-employed, it could be that the deductions need to be made at the basic rate for you on that basis. In terms of company directors, they run limited companies on behalf of shareholders. Directors have different rights and responsibilities from employees and are classed as office holders for tax and NIC purposes. If a person does other work that's not related to being a director, they may have an employment contract and get employment rights. But the important element about company directors is that it is now beyond all reasonable doubt that payments to directors will be subject to pay-as-you-earn and national insurance. In terms of office holders, they would include non-exec directors and pension trustees, where again their rights in terms of employment would be different, but still normally the requirement to operate pay-as-you-earn and national insurance. The big questions might be, are you in business on your own account? Do you go in and produce your own company cards with your own name and company? Or are you representing somebody else? Do I say, who do you represent? This has always been an issue with presenters. Are you from the BBC? Or are you actually a self-employed person contracting to the BBC? And that's always an interesting element. And that's why presenters have been very much in the spotlight on that basis. In terms of the tax process, you look at the first tier tax tribunal, then the upper tier, and then the Court of Appeal. I wrote in September last year about how I thought the court system was too long. Justice delayed is justice denied. However, if I look at the employment law process, I look at the employment tribunal, then the employment appeal tribunal, and then the Court of Appeal. And you do need to be careful about cases in HR where there is a dispute between the employee and the employer, not involving HMRC. That will go through this process, whereas a process to which HMRC is a party will go through this process. In terms of control, what we're looking at is has the power to decide the things to be done, decides the way in which they'll be done, decides the means to be employed in doing it, and decides when and where it shall be done. So when I look at it, is the degree of control without restrictions? And do I have the lawful authority to command? If I do, then I'm more likely to be an employer commanding an employee. Particularly if, for example, let's say I have a project-based element where I've got a project that gives a degree of autonomy. I just want the project done. I get somebody to sweep my chimney. All I tell them is to sweep the chimney. They come at an agreed time. They do sweep the chimney and then they go and they want their money at that point. It's quite expensive in London to sweep a chimney. I think I paid nearly 100 quid a few months ago. If we're looking at self-employed, then it could be I could ask them to obey any reasonable instruction, and that's often the difference between a specific job or project base or business as usual, BAU. If you're carrying that out, you're more likely to be seen as an employee. So the factors there, self-employed, no obligations to give or accept work, can negotiate or set rates. So as a self-employed person, I'm always negotiating rates and thinking about when I want to take holidays and therefore what days I'm not going to do lecturing or other consulting work. Mutuality of obligation, however, with an employed, there's a greater degree of control. I have to accept reasonable instructions and do what my employer tells me when they tell me. The employer, however, needs to set the work. The employee must accept it subject to reasonable test, and the rules are set by the engager, not the contractor. In terms of self-employed, you can send someone else to do the job, whereas if you're employed, there are no substitutions allowed. But again, even then, even if in theory you can send someone else to do the job, if in practice you can't, then it is still a personal service. You advertise your business if you're self-employed. Your employer advertises if you're employed. In self-employed, you have a real risk in making a profit or loss, whereas within employee, you receive a set amount of remuneration, and that guarantees a return. Although your return may also have variable elements, such as bonuses. There is, as I said, no silver bullet on this basis. You would look at a combination of factors, and no two engagements are the same, which makes it more fun, but somewhat less predictable. In going back to substitution, you got to really look at you can and you do it. And if that is the case, then that may work. You know, again, in terms of advertising and negotiating rates, to whose benefit, cui bono, to whose benefit is it when you do that? Is it to your benefit or the employer's? Are you negotiating on behalf of an employer, or are you negotiating for yourself? And the same is true of advertising. If I look at taxpayer defences and HMRC responses, the defence may be, well, I work flexibly. And the response is from HMRC, ever heard of 0-hour contracts? Or, you know, sort of on that basis, I can send someone else to do the job. And HMRC's response may be, have you ever actually done this? I pay for some equipment, so do lots of employees. I do not work full time. An HMRC response might be, ever heard of part-time and casual work? I get variable pay. Lots of salesmen get bonuses and commissions. The company and I agree we are self-employed, but what's the economic reality? What are the conditions? That might be the response. And you do need to think about what HMRC might say in response to your investigations. Right, chat, let's have a look. Okay, nothing in chat, nothing in questions. So I'm going to move on swiftly to another subject, capital versus revenue and capital allowances. Now, this is important. This goes back to the foundation of tax, income tax, I should say, not the foundation of tax, in 1799, which was brought in to fund the Napoleonic Wars. It said that the Treasury isn't keen on hypothecated taxes, but actually income tax started as a hypothecated tax. There were lots of other indirect taxes, but they decided in the what became a 25-year struggle against the French revolutionary forces and then the Napoleonic forces, the government said, well, you know, we need income tax to fight the war. And what they said was, well, you should be able to get a deduction for income that you've got for expenses generating income during the time of the war. But we have said that we will abolish income tax after the war, and therefore it's only a temporary element. And therefore, when you look at that, if you look at the picture on the right, the hay that the sheep are eating and the milk and the person who is tending them, that is all revenue expense, whereas the barn is not a revenue expense, it's capital, and this is where it comes from. If I look at plants, you go back to a case of 1887 on that basis. Whatever apparatus used by a businessman for carrying on his business, not his stock in trade, which he buys or makes for sale, but all goods and chattels, fixed or movable, live or dead, which he keeps for permanent employment in the business. What does that mean? Well, the machinery and the plant that you use, which could be very non-movable, but it's not your stock in trade. So, I manufacture leather footballs. The leather would be the stock, the machinery would not on that basis. I have a cold store to keep the leather at a particular temperature to stop it cracking. That may well be considered as plant. In terms of permanent employment, knives and laths, which had an average life of 3 years, held to be plant. And assets which may have more than 2-year test is sufficiently durable to be plant. In terms of the functional test that provides the criterion to be applied, is the subject matter the apparatus or part of the apparatus employed in carrying out the activities of the business. And before you're asked, you think, oh, income tax, permanent thing. Why are they distinguishing between capital and revenue? Well, remember, income tax was abolished twice. It was abolished in 1802 because there was a 16-month peace of Amiens between what was then the UK and France. That broke down 16 months later, and income tax came back. And then in 1816, a year after our glorious victory at Waterloo, income tax was abolished again. It came back in 1842, introduced by Sir Robert Peel. Gladstone wanted to abolish it. There is correspondence at the Board of Inland Revenue saying, hurry up on the assessments because the Chancellor's looking to abolish income tax, but he never managed to do it. That was in the early 1870s. The big picture on this is it revenue or is it capital? If it's capital, is it a tax nothing or is it eligible for a capital allowance? What qualifies for a capital allowance? Plant and machinery. Machinery is easy. Plant more difficult. And the litmus test is the function test. So the question is, does it do something? That's not the right question. The right question is, does it function as apparatus in the trade, or does it merely function as part of the setting, which is the default position? Now, plant, as I say, is more difficult. So let's take a very recent example here. And what you're looking at here is two pictures, and one of them you can hardly see behind. One of them is a key. And the interesting thing about a key is you might think, well, this looks fairly permanent and it just sits there. But in a recent case this year between the Mersey Dock Board and HMRC, the key was seen to have so many sufficient function to allow ships to dock that the quay wall was seen as plant. Behind that, you can only just see to the left, was a silo, and a silo has the May case a function of drying grain, not just storing it, but drying it for a fixed period of time. So the grain goes into the silo wet from the English weather, and then comes out dry, suitable enough for my cornflakes, and to keep them from going soggy quickly on that basis. And those perform a function, and on that basis, they are seen as apparatus in that function and would be plant. And this is worth a loss of money. Capital allowances are deducted from trading income. Allowances are also available where qualifying activities other than trading are carried out. This includes a property business or managing the investments of a company in an investment business. The general tax principles are to establish whether works are revenue for tax purposes, necessary to consider several issues. Firstly, only the subsidiary parts must have been renewed rather than replacing the whole of the entirety. So you can't replace a whole building. You might look at, are you renewing it? Are you repairing it? But if you knock something down and replace it, that's likely to be capital. Also, the asset must only have been replaced with its like-for-like nearest modern equivalent rather than enhanced and improved. Areas of difficulty in practice: alteration, improvement of the asset's capital, notional repairs. So take an example. Let's say I've got a leaky roof. So instead of dealing with the leaky roof, I decide to build an extension, a roof extension. The roof extension would be capital, but I've obviated the need for repairing the roof. Can I get a deduction for what I would have spent on the roof repairs? And the answer is no. But what I can get is if they're different materials and modern technology. So, for example, I changed materials because the previous ones wouldn't now pass fire checks. That would be an example. And single glazed windows replaced with double glazed windows would be a good example here. I want to look at a couple of cases. So one of them is about a driveway, and the other, a more modern case, that one, and the other one is about a cinema. So this one you need to think about, because I'm going to ask you what you think. That's just a warning. The appellant leased a vehicles, Steadmast Manufacturing and Storage versus HMRC. The appellant leased a vehicle and yard. The latter had not been resurfaced since before the site was acquired and was in poor condition. Some areas were unstable and unsuitable for use by forklift trucks, although they were used when necessary to turn trailers for articulated lorries. As these areas were used less often than other areas of the yard, weeds grew through the surface area, such that in overhead photographs, the areas appear green rather than paved. Historically, the yard was repaired twice a year by patching it with gravel. The forklift trucks in particular would dig into this material with their tires. As this patching became less effective, it gave rise to health and safety concerns, and the company decided that the yard should be resurfaced, doing a proper job on this basis. Is this revenue or capital? So the work was undertaken as a single project, as well as resurfacing. A drainage channel was added between the factory and the resurfaced area to stop water from running across the yard and to allow an expansion joint for the concrete. The cost of this channel was only £740. Overall, there was no increase in the size of the usable area and no increase in the load-bearing capacity of the yard. The total cost of the work was approximately £74,000. Was the expenditure capital, revenue, or nature? You decide. Can we bring in the poll on that basis? Is it capital or is it revenue? So you got a couple of minutes to decide on this particular point. I'll give you 30 seconds more. Capital revenue. That is the question. Okay. Let's see what you said. Ooh, really close. Not quite the referendum result, but 54-46. And on that basis, a minority have said it's revenue. And actually, the minority is correct on this basis. It is revenue. This was what the FTT said. There was no improvement in the yard compared to its original condition. And the works only return the yard to its previous standard. If you just take something and return it to its previous standard, it is a repair. There was no increase in the usable area compared to the original. There was no evidence of any increase in the load-bearing capacity of the yard. HMRC had argued that the expenditure was capital because there would be no further need for repairs for up to 20 years. But prevention of the need for future repairs simply meant that the job had been done well in the first place. If HMRC were correct, most repairs would be treated as capital, which is clearly not the case. And the additional drainage channel did not alter the outcome. I could have been really mean and given you a third option of, a mixture of the two. It was a minor addition to the works, and there's no evidence that it made a substantial difference to the yard or factory, and the appeal was allowed. In terms of this, capital revenue is a question of law to be determined in the light of the facts of an individual case. No single test. Authorities' case law identify approach and relevant factors. And interesting for the accountants out there, the question is not to be determined by Accountancy Act evidence. So that's not the final say, but that is informative, but not determinative. And there's a growing body of statutory law requiring statutory treatment to be adopted for tax. So please do speak to the accountants on that basis, but and that will help, but it is not determinative. Final one I want to look at is polythene pipes. And with polythene pipes, what you're doing there in that particular element was putting in the polythene or the plastic into old lead pipes, which meant they were less likely to break and more likely to work. In the UK, Transco were only doing 1% of the network replaced per year, and that was considered as revenue expenditure. Also, because there was no change in the pressure of the gas. So in other words, no material improvement. All it was doing was bringing it back up to the standard which presumably the old iron ones had when they first were there. And you're just using a new technique to renew it. Whereas Auckland Gas Company Limited versus the New Zealand CIR, you had an insertion of polythene gas pipes into old iron ones, higher pressure gas, and 23% of the network was replaced over 5 years. And that was deemed to be capital expenditure because actually what it achieved was it was a much larger element being changed over a shorter period. And at the end of it, there was a material improvement in the case that you could put higher pressure gas through it. Okay, moving on swiftly, we'll talk about employment taxes and why they're important. Let's take an example here. So an employer gives £1,000 to an employee. I mean, it's expensive. £450 of income tax, employee NI 20, total costs 470, net to employee 530, because obviously top rate, you're in the upper earnings limit. Beyond that at 2%. Employer pays, and this is from next month. Thank you, Rachel Reeves. I noticed that the figures out today show that the economy has shrunk again in January by another 1%. What a surprise. I may be talking more about that in the consumer budget briefing, but for now, I will resist commenting further. And if you look at that, you've got £1,150 going into the pot from the company, including the costs of national insurance, and you're only getting £530 out on that basis. Whoops, a leakage of more than 50%. Even for basic raters, it's quite expensive. The basic rater has done better from the Jeremy Hunt inspired reductions in employee NI. £200 income tax, £80 employee NI, total cost 280, net cost to employees £720. Employer pays £150 NIC. Well, that will be from next month. And, for your average Tommy Atkins, the leakage rate there is still 38.4%. You're still putting £1,150 into the pot, including the cost of employer NIC, and the leakage there is 38.4%. Why are employment taxes so important? Well, small changes, large consequences on that basis. Tools of elements you would think about. If I have a temporary workplace, I could get a tax and NI advantage on that. Secondment is certainly easier from that point of view in terms of temporary workplaces and a tax advantages on deductible travel and subsistence and accommodation. Less than 24 months in a place, also an interesting element. From next month, the foreign income and gains 4-year regime, potentially excluding tax and national insurance from that element. Tax approved share schemes, also very useful. And non-remittance of funds. Well, that's only for another month, although, the remittance basis is going next month. But an important element, because it still historically will apply to foreign income that was excluded on the remittance basis in the past. Full tax and NI charge on a permanent workplace, no tax, travel and subsistence going there. A new employment has less flexibility. If you're in a place more than 183 days, you're automatically resident. If you're greater than 24 months in a place, then no detached duty relief available. A long-term resident, full tax and NI charge after 4 years, capital gains and income tax on the current rules. 10 years, then you end up with potentially IHT on your full assets worldwide. Non-approved share plans, full tax and NI. Remittances to the UK, full tax and NI, unless from next month there is a temporary repatriation facility with bargain basement rates of 12% for the next 2 years and 15% the year after. Don't say the government isn't generous. If I look at detached duty relief, potentially, I've got 100,000 of housing, 10,000 of travel, 10,000 of subsistence, and 20,000 of utilities. Potentially, my tax and employee NI is nothing, and the employer NI would be nothing. Now, otherwise, if I pay it as it might be for an expat on a grossed up basis, I could end up with a, tax and employee NI of nearly 125,000. And that's employee NI, and employer NI at the newly minted 15% rate of nearly £40,000. And some of that will have to do with the arrangements that are made. And those arrangements between the company and the employee are probably a HR matter, but they do need to be aware of the potential tax consequences. If I look at pay as you earn, that's again a major issue where you need to involve particularly HR, but maybe also company secretarial. The scope of it, UK employer, doesn't have to be a UK employer. UK employee, or UK-based employee, UK source earnings, employment-related securities gains, reimbursed, so that's, like shares or options on which you make gains, and reimbursed taxable expenses. But PAYE has a large remit. There is a worldwide scope. So even if non-UK employer, non-UK national, but performs work in the UK, and here, famous case of Clark versus Oceanic. Oh, it's not a recent case. I learned it when I was studying many years ago. Clark versus Oceanic is a good example of the extraterritorial nature of pay as you earn, forcing potentially foreign entities to operate pay as you earn in the UK. Pay as you earn needs to be done on a monthly basis. You will also need to do RTI or real-time information before you make the payment, and that's done on software. It also covers some vouchers and benefits as well as some shares. So it's important to understand the ambit of pay as you earn. The vouchers are cash vouchers or vouchers that can be converted into cash, and benefits again would be generally cash related benefits, or shares that are readily convertible assets would be within pay as you earn. Any questions on that? No? Okay. So let's look at some of the employment issues: pay, benefits, expenses, and bonuses. So in terms of NIC, well, I talked about it going up, but let's look at the, some people think, well, NIC, it's national insurance contribution, it's just another form of income tax. Well, it's not. It does have different rules to it. Oh, a question. Let's see if it relates to this bit or the previous bit. So someone's asked, is a voucher for something that cannot be converted into money tax for pay as you earn? No, it isn't. So if I get a voucher which cannot be converted into cash, then it would not be subject to pay as you earn. It would probably be a benefit in kind, but certainly at this time of year, you might be thinking about your £50 trivial benefits on that basis, which would escape tax. So let's say I have a voucher that is only redeemable for flowers produced by Freddie's Flowers, for example. That would not create either a national insurance or an income tax charge. If it's a trivial benefit, i.e. under £50, and is not a reward for services. If it's a voucher of, say, £100, then that would be taxable on the employee. But if it's one that is not convertible into cash, then it shouldn't have to go through pay as you earn. NIC versus tax. Do we get any benefits? Well, tax, you get the warm sensation of paying tax, but it doesn't give you any benefits per se, apart from, the normal benefits of getting public services. With national insurance, yes, 35 years of contributional credit in order to get your full state pension, and there are other benefits which you may need to look at. In terms of how it's assessed, tax is assessed on an annual tax year basis, where NI is normally on a pay period, which could be monthly, weekly, but there are anti-avoidance provisions for directors who shouldn't therefore be able to manipulate the weekly and monthly amounts to minimize their national insurance. There'll be a reconciliation on that basis for directors. But it does mean the government can introduce NIC changes partway through the year if they wish to, which is what Jeremy Hunt did when he reduced national insurance from 13.25% for individuals down to 12, and then from 12 down to 10, and then from 10 down to 8. Residence and earnings basis, well, that's what tax is based on, whereas national insurance is normally a very strict receipts basis. Where are you based? Where are you resident at the time? Where is your liability at the time the bonus is received? Taxes on broad income, national insurance is normally based on earnings. In terms of NIC versus tax, what you're looking at there is benefits in kinds are taxed. NIC is only employer only, Class 1A NIC. So a significant advantage to those employees to receive benefits if they're below the upper earnings limit of £50,270. Above the upper earnings limit, there's only a 2% advantage, obviously. In share gains that are non-tax advantaged, they would be taxed, but there's only national insurance on readily convertible assets, broadly speaking, where shares can be traded or converted into cash relatively easily. In terms of tax and social security contrasted, tax, you get double tax treaties, social security, and they don't cover social security. There are normally social security agreements. There are very few multilateral tax agreements where it covers a number of jurisdictions, whereas for social security, you've got the European Economic Area one, which covers 31 countries, maybe more, in terms of the EU, the EEA3, the UK, and others. Because the UK, as part of the Trade and Cooperation Agreement, effectively stayed within the European Economic Area Agreement. Earnings basis and residency, as is talked about, as opposed to literally, where are you sitting, where you resident, where the money comes in. So on that basis, the other element which is different is on an international basis, you apportion between two states, whereas under Social Security, it's normally only one state. What's the difference between a benefit in kind and a payroll item? So here, I've got £1,000 of medical insurance, and the employer makes the agreement with Bupa. Other medical insurance companies are available, medical insurance entities, and the company makes the payment, and the contract is with the employer, and the employer issues, gives the coverage to the employee. That would be a benefit in kind. The Class 1A from next month will be £150. The employee tax as a basic rater would be £200, and the employee NIC would be £0. What would be more expensive but less, differential with the cut in primary NIC is a little bit less. The employer gives the employer £1,000, and they sort out the payment with Bupa, and they have the contract individually. On that basis, the Class 1 secondary NI on the employer is 15% from next month. Is the same. The employee tax at £200 would be the same, but it would go through payroll, and there would be employee NIC of £80 at 8% on that. With employment, you've got monthly submissions, RTI, full payment submission, required for every employee, and you need the full name, the gender, the date of birth, the full address, and their national insurance number. Who pays income tax? Well, if it's a P11D item, then it's, income tax, the employee would. If it's a payroll item, still the employee. If it's a pay-as-you-earn settlement agreement where the employer has agreed to pay the tax on behalf of the employee, then obviously the employer pays. Who pays the NIC? P11D would be an employer only. That's where it's benefit in kind, Class 1A. Payroll item, if it's gone through the payroll, because it's not a benefit in kind, but because it's a cash amount, then it's the employer and employee. And for a PSA, because you're paying the tax and NIC on behalf of the employee, it's the employer only. Is there a gross up? No, not for the P11D, because the employer's responsible for the tax. Under payroll, again, the employee pays tax. But for a PSA, there would be a gross up because not only do I get the benefit, I'm also not paying the tax, the employer is, and that's an additional tax liability. To look at how that might work, an additional rate taxpayer, what you're looking at is, 450 quid tax, or 1,150 NI cost to the employer. The same for payroll, but a £20 employee NIC cost. And then with the PSA, I gross it up, and the employer cost, income tax is high. So is the NI cost. That's gone up to my 15% effectively grossed up on that and the benefit. If you're a basic rate taxpayer, then you end up, the difference in the payroll is £80, not 20. And the PSA, however, is much less because the basic rate, the tax is less. Where to report benefits? Well, if the benefit is provided directly, as we said, direct between the employer and provider, typical benefits, cars, medical insurance, and cheap loans. Payroll, the employee lays out the cash and is reimbursed. Typical benefits, home telephone in employee's name, commuting cost extras. And PSA, the employer provides the benefit, and the typical benefit there that you would gross up would be staff entertaining. I think, if you're entertaining staff as a reward, it is slightly disincentivizing if after that the employees end up with a bill for the staff entertaining. So normally employers will gross that up and pay it through the pay-as-you-earn settlement agreement. Okay, it's 11 o'clock. The next element I'll go through is expenses, main principle, and I'll talk about that when we come back in 8 minutes. Any questions? If there are no questions, let's go on to the final session. So what we're looking at here is the idea of expenses, the main principle, wholly, necessarily, and exclusively in the performance of the duties of the employment. Contrast that to putting an employee in the position to do their duties. That's why, for example, commuting costs are not allowed. You think, well, it's work cost, but it's a cost to put an employee in the position to do the duties. Now, importantly, in terms of the self-employed, it's only wholly and exclusively. There isn't the necessarily, and there isn't in the performance of the duties of the employment. And the necessarily sort of means that is it necessary to do so, which is an additional test, and the other, which can affect things such as training. And the other element is a sort of time element in the performance of the duties, which makes the deduction quite restrictive. Of course, there are caveats. It's not a reductum ad absurdum. There is some apportionment allowed on a reasonable basis. So in other words, HMRC isn't saying, well, you could use a library to work. Why should we give you a deduction for the office? Also, an employer has major input on what is allowable. So, for example, you could get first-class travel. If the employer deems that necessary, you don't get a tax charge based on the difference between standard and business, or business and first-class travel. Obviously, in terms of expenses and benefits, we look at business entertaining. That is not taxable on the employee, but is importantly is not deductible for corporation tax purposes. Business travel would, as I say, normally be deductible. Fees and subscriptions to professional bodies. HMRC lists the recognised bodies that you might use. If I use a hire car to travel, that's still allowable. Business use of telephone. Business expenses on business credit cards allowed. Even business expenses on personal credit cards would be allowed, but you get into complications of obviously having to do more accounting and work on that basis. And then there is the issue of who's incurred the liability. Are you just reimbursing cash, in which case you could end up, if it's taxable, actually with a pay-as-you-earn liability. Business fuel for business mileage, again, excluding commuting. And of course, there are other elements there. In terms of joining the company, one of the elements you'd think about would be golden hellos, relocation, international transfers and status. So, for example, if I'm international, it would be more complex. Maybe I've got some elements of earnings relating to my duties in Switzerland, some in Germany, and some in the UK. Potentially, if you look at the first two arrows, one of them could be encompassing a period I'm in the UK, Switzerland, and Germany, so an apportionment of the reward I get, the bonuses. The second one may be only relating to Switzerland, and the third one, both my Swiss and German periods have ended, and it could well be that actually the third element, the third arrow to the end, would be only UK based on that UK accrual. If I look at the bonuses awarded, if I award them at the end, I'm in the UK, the likelihood would be that it would be subject to UK and I only, because there are social security agreements with Switzerland and Germany. But in terms of the tax, if the earnings relate to some periods where I'm resident in Switzerland or Germany, then potentially, or indeed have substantial duties in those countries, I could end up with an apportionment of the bonus, with part of it being taxed in Switzerland, partly in Germany. And their companies need extensive travel logs to look at those elements. The other element, which is important, is from an accounting point of view, where are my costs charged, and are they actually deductible on that basis? If I get an inducement payment for starting in a business in exchange for starting employment, that receipt would normally be taxed on the first day of employment. Any questions at this point? So, there are no questions. Let me move on to and of course, in terms of the payment, it may be spread in the accounts over a period of time, probably not. But you would look for an inducement payment to be seen as revenue rather than capital. So let's look at entertainment and Puritanism. Oh, I've got a question. Before I go on to that, Q&A. Copies of slide. That is being provided by K3. So, the question of entertainment is, since the 1960s, there's been concern about companies effectively minimizing their tax and giving employees expensive rewards based on entertainment. But as I say, it's been generally business entertainment disallowed in the corporate accounts, and staff entertaining creates a staff liability, a liability on the members of the staff. But there are differences. For example, marketing, which may have an entertainment element, if the primary purpose is marketing, you could end up with a deduction there. Again, it's an area that you will need to consider with the accountants about how they classify elements. Say if I'm launching a new car, for example, potentially the cost of not launching the new car could well be within the marketing budget. If I look at food, generally food would be taxable on staff. But if I've got a business lunch or I'm attending a conference, then normally speaking, the subsistence costs would not be deductible. Would not be taxable. So the subsistence costs would not be taxable and would be deductible in full, including potentially VAT as well. What would not be allowable is I then go off to the bar and drink lots, even at a conference. That isn't going to be allowed. Reasonable drink with a meal could be allowed, would be normally allowed, although it may not be allowed in terms of reimbursement. I've had companies who say, under no circumstances will we reimburse alcohol at all, even if it's a reasonable amount on that basis. But this would be something, HMRC will allow you half a bottle of wine with a meal, which sounds plenty in my view. But what they wouldn't allow is you repair to the bar, drinks not with a meal, sort of shades of the Scotch egg with the drink. That would not be allowable for tax purposes, so drink on its own. The annual functions up to £150 per head. That's based on each person attending, irrespective of whether they're an employer now or not. So you've got a spouse, partner, significant other. Can be split across more than one function. So your 150 is a year, but you could have two functions of £75 each. And open to everyone, or there is at least an equivalent open to everyone. So not everyone has to go to the same function. You could have one in Scotland, one in Wales, one in England, one in Northern Ireland, for example, wouldn't be an issue. I talked a little bit about or mentioned trivial benefits. So some of the elements to think about there is give me more, how to push it, how far can you push it. HMRC, I think, conceded a bit more than they initially thought. So always doing guidance on trivial benefits and trying to ensure that employers are not taking trivial benefits that they should not. A reminder of the rules. Condition A is that the benefit is not cash or a cash voucher. Condition B, the benefit cost, either the cost of providing the benefit or the average cost, where provided to multiple recipients and it's impractical to calculate the individual cost, does not exceed £50. Condition C, the benefit is not provided pursuant to relevant salary sacrifice arrangements. Salary sacrifice is a bit of a no-no in many areas. I think it's basically you're down to pensions, childcare vouchers, pension advice. Those are the sort of areas you're allowed salary sacrifice without an issue. Otherwise, in most cases, salary sacrifice is ineffective and even worse than that, possibly damaging in terms of your tax position. Oh, a question. Does the £300 apply to both an employer and a partner? Occasion of marriage, £500. Now, I think, yeah, you are confusing two elements. One is gifts on the occasion of a marriage, which are free of IHT, which depend on the type of relative you've got. In terms of going staff entertaining the annual function, if I take my wife with me, then the company could spend up to £150 a head, £300. The occasion of a marriage bit is where I can give a gift. So I could give a gift to one of my children on the occasion of the marriage of up to £5,000 for me. And my wife could also give another £5,000 on that basis. I don't understand. In other words, it's not a monetary amount, it's the amount that's spent on the annual function for, that I attend is what you're looking at there. So I can't give the cash away. On all these occasions, it's never cash. In other words, you could do the £50, but that would have to be separate. So if I was, say, doing, taking the staff out, and it's not in recognition of particular services. It's nice weather for, we've had it's nice weather. Spring is here. And I decided I want to take everybody out. If I go to Pizza Express, it's going to be less than £50 per head, and I could have that as part of a trivial benefit. The other element would be is that, effectively, I can't do it more than 6 times a year in terms of potentially, particularly closed companies. We're looking at, £300 if I'm a participation in a closed company. So that would normally be up to £50 a year, 6 times a year. Although it could be that I have a series of trivial benefits which are lower than that, which add up to no more than £300. Personal incidental expenses. Remember, for an overnight stay, I can get personal incidental expenses. They used to be used for telephones till everybody had mobile phones. Used to be used for newspapers until people read their newspapers also on their phones or their laptops or their Kindles or whatever. So now it's used as sort of maybe a bar bill, £5. And if it's overseas, then it's £10. Oh, another question. I doubt I'll have time, Richard, for long service awards. I think it's 20 years, and I think it's £20 per year, but I can't remember exactly. And then there's a gap between the next long-term service award, but I think it's £20, and that you could do in a form of cash as well. But normally done in the form of a benefit like a watch or something, where you would give something that is not more than £20 a year from recollection on that basis. If you send me an email, I can point you in the right direction. Tax-free benefits that you could be getting, well, they could include the canteen, annual parties, trivial benefits we talked about, equipment for disabled employees, health screening. So I benefit from health screening every year to tell me I should cut down on various things like sugar. And as long as it's available to all employees, even if they don't take it up, that health screening would be tax-free. Late night taxis, but do watch in terms of late night taxis when you have been working, rather than you leave the office, go entertaining, come back to the office and then take the taxi home. That would normally be considered as beyond the scope. And long service awards, as I said, potentially tax-free within the limitations that I was talking about. I think it's £20 per year of service, but they could have uprated that. Suggestion schemes. So for a suggestion that isn't taken up, there's a small amount, I think £25. Food vouchers, particularly where you're offering that as an equivalent to a canteen because the individual cannot access the canteen. Medical treatment abroad. So you fall ill abroad, potentially the medical treatment abroad would be tax-free. Retraining courses, sports facilities, welfare counselling. The sports facilities would need to be on an employer's premises, work-related training, SIP shares, and indeed nurseries which are on the employer's premises, which obviously helps larger companies rather than smaller ones. Any other questions? So I'm going to talk a little bit more about MTD, or making tax difficult, as I call it, making tax digital difficult. So the principles about MTD is that it's quarterly reporting. It's now needed if you want to do a VAT return, you've got to use the portal, and that requires MTD compliant information. You can use bridging software from your spreadsheets on that basis. But you do need to have information held digitally. And as I say, you could go the whole hog and do digital accounts, or you could have a spreadsheet with bridging software. The autumn statement developments was making tax digital, small business review outcome. No major changes were announced in making tax digital for income tax. That is the previous announced dates of April 2026 for gross income turnover above £50,000 and April 2027 for gross income turnover above £30,000 remain. So £50,000 April next year, £30,000. And so bringing in more businesses in April 2027. Why are they doing this? Well, because most of the tax gap is accounted for by small and medium-sized enterprises and indeed old-fashioned tax evasion and tax evasion, rather than what people suspect, have always perceived the point, large companies. Large companies' contribution to the tax gap between what HMRC think they should get and what they do get is only about 1.8 billion, whereas SMEs contribute about 15 billion in terms of errors and mistakes, according to HMRC, another 15 billion in terms of old-fashioned evasion on that basis. And that's why MTD is coming down the track to try and allow HMRC to keep more of a track on what people are doing. And then I suspect to introduce a mandatory quarterly payment system. 2 questions. Can gym membership be allowed as tax-free benefit under the sports facility? No. If the employer has a gym in their facility, that's free or can be free of tax. But if they pay for gym membership, the answer is no. Is MTT going to be the same reporting quarters for everyone compared with staggered for VAT? I don't know the answer to that. I think it does depend on your accounting year end. If I'm wrong, I will email you on that basis. So I think it's going to be based on your year end rather than specific to everybody, the same ones. So, sorry, it's going to be specific to everyone in terms of their accounting period ends on that basis. So then we come to VAT. Is this better idea to put all the clients with turnover more than 30,000 in MTD from April 2026, rather than then doing the same work again year after? Well, I would say there are two issues with that. One, you need to get the client on board, and they may say, well, why are you doing MTD on a voluntary basis and racking up more fees and expense when you're not required to do something? An advisor's on a much more sticky wicket if they're doing things that they're not required by law to do. For example, replying to nudge letters from HMRC unless they get the permission of the client. So the question is if I've got a turnover between 30 and 50,000, I might not want to do MTD 26, 27. I want to take advantage of the relaxation which the government has given me. So I think there is a cost benefit analysis. And whilst it might be convenient for you to do MTD on a voluntary basis, you really do need the permission of the client. And if it's going to cost them extra money, you need to be upfront with it. So VAT, as I mentioned, the threshold is linked to compulsory MTD at the moment for VAT. And as I say, will be of general, more wider application come April 2026, when MTD comes into income tax, whether you're registered for VAT or not. It's applied on goods and services, different rates of VAT, compulsory registration for turnover over £90,000. The previous government raised it from 85,000. Voluntary choice below this, and making tax digital will be triggered, whether it's a voluntary registration or not. A reminder that there are zero rated items. That's the best, because you can then reclaim the input tax and the customer's charged at a 0% rate. And effectively, if you just did zero rated and you were registered, you would end up with tax refunds on a fairly regular basis. So what are we looking at? Food and milk, coffee, tea and cakes, not biscuits, for example. Children's clothes and footwear and baby wear, books, electronic books included, magazines and publications, newspapers, and some medical products would be zero rated. Exempt would be insurance and many financial services, which means that you are indirectly paying VAT because the suppliers had to absorb the VAT they've paid. They haven't been able to reclaim it from HMRC, unlike with zero rating. So you are paying a hidden amount of VAT. This is quite interesting when you come to schools. Some of the schools have decided to whack up their fees by 20%, ignoring the fact that where they pay VAT, they're now able to reclaim, and indeed using the capital scheme, reclaim over a number of years of payments. So whacking it up by the full 20% seems slightly opportunistic. An interesting point. But if I buy insurance, not only do I pay insurance premium tax, but the insurance company will have paid VAT that it cannot reclaim from HMRC, and that will be reflected in the price I pay. 5% is domestic energy, energy-saving devices, helmets and protective wear, and some medical products. And you've got things like, so when you look at different elements of energy-saving products, or indeed, putting in insulation might be at 5%. Again, you need to look at the terms and conditions. 20% would be catering and hot food. So all the questions about the pasties, were they at an ambient temperature or not? And also, is this food for human consumption, or is this something else? Energy for non-domestic use is at 20%. Alcoholic drinks, 20% plus duty, and the duty is charged before you charge the VAT on top. Chocolate covered biscuits and other types of biscuits and crisps and monster munches and all that sort of thing, and all those wonderful cases about food and VAT, which cause a lot of amusement, but are obviously important elements in terms of food and beverage manufacturers. Question. Does charging an electric vehicle count as domestic? Well, if you're doing it at home, it does. Yes, that would do. How does the VAT process work? Well, what you look at there with the VAT process is that you've got the manufacturer pays for the raw materials and services. That's input VAT, so you can reclaim that. He would therefore set that against the charges that he makes for the goods, which would be output VAT. The wholesaler, the output VAT of the manufacturer, becomes the input VAT of the wholesaler plus other costs. And the wholesaler charges the retailer for goods plus output VAT. Then the retailer, the charges by the wholesaler become the input tax plus other charges, and they charge the customer output tax on the goods. And the whole point of this, and you might think, why is all this palaver? Why don't they just charge one on the other on the other? Well, it's different from, say, US sales tax, because the point would be that if you kept on just adding the charge and not allowing you to reclaim it in the chain, you'd get 20% on 20% on 20%, which would give an advantage to a large company that is what we call vertically integrated, which does the manufacture, the wholesale, and the retailer, over smaller companies which are involved in the whole process. Now, in terms of a level playing field, you don't want VAT to basically put small businesses out of business. You don't want to disadvantage them on that basis, which means that at each step, you can reclaim the VAT that you pay if you're VAT registered, but you charge the VAT onto the next person. So at the end, the customer is charged 20% VAT on the final price of the goods. But you're only effectively on that basis getting 20% unrecoverable, generally charged once. With a VAT registered business, the cost is the difference between the input and the output VAT on that basis. For non-VAT registered businesses, the cost is the total VAT charged. So on that basis, at the end, if I'm non-VAT registered and I make supplies to a customer, I've got to recover that cost somehow. I'm not getting it from the government. I'm going to get that from you. And if it's a supply which is exempt, I've got the same issue as well. Voluntary registration is therefore competitive if most goods supplied are zero rated, if the customer can reclaim the VAT. So bill lecturing companies, they're in the process, they tend to be fully VAT, making fully VATable supplies, and therefore their customer can reclaim the VAT. So the fact that I charge VAT does not increase their costs. Also, exports are zero rated for VAT, generally speaking. Where it's not competitive to voluntarily register is where the customers cannot reclaim VAT and the customers have restrictions on reclaiming VAT. Other types of VAT schemes. So for cash accounting, it's applicable if it is less than 1.35 million, if you can do it on a cash basis, which means that bad debts are automatically allowed. Annual accounting is 1.35 million, and the flat rate for VAT, where on that basis, we'll talk about the flat rate next, is only 150,000. And that means on that basis, you get a simplified VAT position. With a flat rate scheme, you pay a fixed amount of VAT over to HMRC. That's just based on your turnover, so you don't have to worry about the expenses. You keep the difference between what you charge your customers and what you pay over to HMRC. You can't reclaim the VAT on your purchases except for certain capital assets over £2,000. To join the scheme, your VAT turnover must be less than £150,000, excluding VAT, and you must apply to HMRC for it. So when my business was relatively small, I used the flat rate and it was simple. Now I need to look very carefully at my expenses and my income. And what I do is my turnover regrettably is below 1.35 million. Therefore, I have to do an annual VAT return 2 months after the end of my year. I then do quarterly VAT payments on that basis. These are 3 payments on accounts in July, October, and January. And then the 4th one is following my VAT return. And as my VAT return's done, what they do is adjust my quarterly VAT payments for the VAT for the VAT return that I've done, in terms of they estimate what my VAT will be in the future year. In terms of recharges of VAT, so I recharge VAT on expenses if I have expenses, even if they're not VATable expenses, and I recharge them out. Let's say I travel to Liverpool to do a lecture, and I travel by train, even though the train travel is 0 rated. If the train cost return is £200, I will charge my client £200 plus the VAT on there. The same is true of expenses, subsistence like the hotel costs, but they would generally be VATable, as well as indirect costs. But subsistence might be the meal deal from Boots, for example. And even if VAT is not charged on my cold sandwiches and salad, if I charge that to the client, I would put VAT on the top of that. There is no recharge of VAT on disbursements directly arranged for the client. So I say, here's a legal company that's going to do your conveyancing or whatever. Those ones I've directly arranged for the client. I don't have to recharge VAT on those. Let me move on to the guiding principles of international corporate tax. So that's one of the final elements I'm looking at, is the international element. And there, what I'm looking at is a level playing field between, taking the Embankment Station, between Starbucks on one side and the Blues and Royals Cafe on the other, which is a family-owned business, been around since 1947. They may be on different sides of the road, but from a tax point of view, and in a completely different context, from a tax point of view, what the tax system tries to do is neither to favour or disfavour domestic businesses. You want foreign direct investment, so you want multinationals investing in your business, but on the other hand, you also want a position whereby the company, the individual domestic company or business, is not squeezed out. Companies and business subject to tax on their profits where their principal activities takes place, and companies and business chargeable to corporate taxes where they are resident or where they have a permanent establishment. Taxes are imposed via domestic legislation. International treaties do not impose tax where it does not exist in domestic legislation. Double tax treaties can be used to eliminate double taxation, but cannot be used to impose a tax charge that does not exist in domestic legislation. In terms of more principles, economic substance takes precedent over legal contracts if the two contradict each other. And that's important. A lot of people think that they can create a cat's cradle of different interlocking legal agreements that, divert your income to somewhere abroad. But if it doesn't follow the economic reality, if abroad in a tax haven is not providing a real service, then that would not be possible. Employment considerations separate to corporate taxes, but the location of staff may well create a corporate tax liability. And a permanent establishment may well lead to additional corporate taxes due. And a company should not be subject to tax on more than 100% of its income. So if I've got £10 million worth of profits between France and the UK, and I split them 50-50, and then the French say, no, we should be taxing 60%, i.e. 6 million profits, the UK should do a compensating adjustment and reduce their share to 4 million. This goes through a mutual agreement procedure between the two tax authorities if there is a dispute on the share of the cake. Who pays corporation tax? Well, companies and incorporated associations. If residents in the UK, they've got CT on their worldwide profits. Test for residents if you're incorporated in the UK, or if there's management and control in the UK, and that follows the De Beers Consolidated Mines case, and those findings were incorporated in HMRC guidance in the Statement of Practice 1/1990. A reminder of where central management control came from. So, before that, a reminder that if you're dealing in land, there are further anti-avoidance rules to catch non-residents dealing in UK land who will end up with a CT liability. Where in the company residence points, what do you look at as the Statement of Practice 1 1990? Lord Lawburn in De Beers Consolidated Mines versus Howe said a company resides for the purposes of income tax where its real business is carried on. I regard that as the true rule, and the real business is carried on where the central management and control actually abides. This is the highest level of control, distinct from the place of main operations, although the two may coincide. The meeting place of the board of directors is important but not conclusive. If you just centrally manage everything in the UK, but you decide quarterly to have your board of directors meetings in, say, Spain, that would not necessarily mean that the company is non-resident. Directors may not actually exercise central management control, and if not, HMRC look to establish where and by whom it is exercised. There are particular issues with parent subsidiaries. How far do the directors of the subsidiary make the decisions? As I pointed out, for a company is chargeable to corporation tax in two situations. If it is resident in the UK, it's liable to tax on its worldwide income and profits. If it is not resident in the UK but carries on a trade here through a permanent establishment, it is liable to corporation tax on profits attributable to the permanent establishment. Even without a permanent establishment, a non-resident company can suffer UK tax by way of withholding on, say, royalties and interest payments. But take an example, if I'm a French wine company and I decide that because of climate change, I need to move my grapes further north because it's too hot in the south, I might decide to establish new vineyards in Kent and Sussex. On that basis, the vineyards in Kent and Sussex would be a permanent establishment. They would be probably a branch of the French company, and therefore on the profits of the Kent and Sussex vineyards, they would need to pay UK corporation tax and claim a credit against their French tax liabilities for any income which is included, foreign income included in the French tax computations. So I establish a branch overseas. That branch, if it's a permanent establishment, which is likely to be, will have a local tax liability, even as a branch of the French entity, for example, where legally it's considered as one company. The French company may need to will need to file French tax returns, probably include the UK income, but will get a credit for UK taxes paid. In terms of permanent establishment, that is the building blocks for corporation tax, pay-as-you-earn and social security. In terms of pay-as-you-earn and social security, we look more at a place of business, but they are very much interlinked on that basis. And then you get the concepts of trading in or trading with. So if I have a sales trip, that's trading with, and I'm not creating a permanent establishment. Same with a conference or an exhibition, a non-permanent exhibition. But if I'm providing services, it depends on the services. With warehousing, am I storing my own goods? That would not necessarily create a PE. But if I'm storing other people's goods for a fee, then that probably would create a PE, as would a fixed base. And of course, so would manufacturing. The questions, identifying the problems. Am I trading in more than one country? Do I live even temporarily in more than one country? Where are my costs charged? And what are my activities? And the issue is obviously possible tax in two countries. You are able to exclude from the definition of permanent establishment the storage, processing, and delivery of your own goods, the purchase of goods, collecting information, public relations and sometimes R&D, invoicing and collecting claims from another country. But again, watch, various countries have circumscribed those the scope of the auxiliary activities and have reduced the ability to avoid a PE. And therefore, with more PEs, you have more corporation tax filing requirements, and also the relationship between the PE and the head office you need to look at to ensure that the profits are properly allocated between them in terms of the different jurisdictions. And that's where transfer pricing comes in. A PE likely to be created, you've got a fixed place with a fixed telephone line, an office, somewhere where you store secure documents, and somewhere where you're known to do business. As I said, exhibitions, the temporary nature of them would not generally create a PE, despite the fact you could do millions of pounds worth of business there. And as I say, you know, the general definition is found in the tax legislation, and the area that causes the most problems is a place of management, which of course could be a home. And the problem with this is, let's say the person on the left is a sales director, they go and set up an operation in another country that could create a permanent establishment. And if the person on the right is a business manager and decides to spend all his time in his villa in Spain and is the owner manager of a business, you could end up with a change in central management control. But that is very related to the companies. So the final polls that I look at are HMRC examples. So have a look at this one. Only got 7 minutes left. But Juan, who works for a foreign entity in State D, comes to Brighton on holiday and stays on to work for a total of 40 calendar days, including his holiday using the office of a UK affiliate as a base. He enjoys the experience so much, he decides to do the same thing 6 months later. Is it a permanent establishment or not? Vote now using the poll. I'll give you 30 seconds on that one. Okay, let's get the answer to that one. What did people put? Scores on the boards? Not permanent establishment. That is the right answer. And it's interesting because a lot of companies during COVID limited people to say you can't extend your time in another country and work there, even though it makes no difference to our operations because we're worried about a PE. Well, according to HMRC, because the situation is really a personal one and not structured, no PE. Let's look at the second one. Francine, a French national with an English partner, joins a French company on a permanent contract, which permits her to spend a fixed 3-month period each year working in the UK. Here, 30 seconds on this. What do you think? Anyone? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Scores on the door. Permanent establishment is the right answer. The word that is clear on the Francine one is this fixed 3-month period, which could easily create a PE. Let's look at the third example. Alexei, Luca, and Sarah all work for a foreign entity in State C. They come to the UK on holiday for the same part of the year with their families, staying at different addresses. They are all permitted to stay on an additional 30 days to work in the UK by their employer, using the office of a UK affiliate company as a base. Let's bring up the poll. Yes or no? Permanent establishment, not permanent establishment. 30 seconds. Scores on the doors. Not permanent establishment. Yes, very much follows the Juan example. Just because they're 3 people working after their holiday in the UK, it would be on the same basis, not a permanent establishment. Let's look at the final example. Example 4. Company T has a team of staff in its Zurich office. Over the course of 9 months, 6 staff are permitted to spend 6 weeks each intern at an affiliate company's office in London working on a project. Let's put the poll up. Scores on the door. No, I'll give you 30 seconds on this one. Answer. Let's see the answers. Ooh, much closer on that basis. But it is, so first occasion, it's the minority who are right. It is probably creates a permanent establishment because they're working on a project. There is a structure to it on that basis. So working on a project, not just some form of, I just happen to be working there. Okay. I hope you found that of use. I'm now going to look very quickly at BEPS for a couple of minutes and then very quickly at an R&D. So with BEPS, beta erosion profit shifting, you're taxing profits where value is created. In an increasingly internet-connected world, national tax laws have not always kept pace with global corporations, fluid movements of capital, and the rise of the digital economy, leaving gaps that can be exploited to generate double non-taxation. What they did was 15 actions, and they are now 10 years old. But the key themes of coherence, substance, and transparency, coherence between tax systems, substance, and this is really important in the accounting world, is there a substance transaction, or is it some sort of airy-fairy transaction that bears no economic reality? And transparency on a transaction to make sure that actually what you're looking at is something which is transparent to revenue authorities on that basis. The elements that I'd like you to think about there is twofold. One is that most of the actions under the BEPS project are worth looking at if you ever do international tax. The one area that is quite different is the addressing the tax challenges of the digital economy. That's one area that has not been totally addressed, and that's where Pillar 2, the global minimum 15% corporation tax rate, comes in. That has been signed by the inclusive framework has been signed by 140 countries. But interesting enough, the US under President Donald Trump has said we're not doing Pillar 2, the global minimum 15% tax, unless Congress approves it. Most of the rest of the elements have been fulfilled. The area that I would talk about, mention just very briefly, is contract is no longer king. So if there's a dispute between the contract and the actual reality, what you look at is the actual reality of what's happened in accordance with the characteristics of any transaction reflected in the conduct of the parties. So the contract is one element, but the conduct of the parties, what they actually do, the value that they actually create, the transactions that they actually do, the economic reality is much more important than the contract. Conduct trumps contract on that basis. There is this 15% global minimum CT rate, and it's something which somebody else may deal with in more detail. But it's fair to say you know, the OECD Pillar 2, the 15% minimum CT rate worldwide phased in on the 31st of December 2023. And indeed, the backstop was brought in. So, you know, backstop to make sure that within a group, 15% is levied, even if the top company isn't levying it. And that's really important now that the US has withdrawn from it. That was phased in for chargeable accounting periods beginning on the 31st of December 2024. In terms of this, the element that you would look at is that different countries have adopted it at different times. Most adopted the basics of Pillar 2 chargeable accounting periods beginning 31st of December 2023, but some elements, notably the backstop, 31st of December 2024. In terms of UK company profits, if the effective tax rate is 25%, not an issue. If you have a subsidiary in a country with an effective tax rate of 25%, not an issue. However, if you've got a subsidiary in a jurisdiction where there's an effective tax rate of 10%, under the current rules, the UK would have to pay another 5% on the subsidiary's profits to UK HMRC, not to the subsidiary's jurisdiction C's tax authority. They would pay it to UK HMRC. So in this example, 5% of 10 million, either 500,000, would be paid by the UK company to UK HMRC on that basis. And you can see how that forces jurisdictions, or most jurisdictions, to say, well, if it's going to be paid, we want it paid to our tax authorities. So they're likely to create, as a number of tax havens have done, a 15% minimum corporation tax rate where the group's global tax revenues are above 750 million euros. My final thing, I will only keep you a couple of minutes, is R&D. And there are questions about how to get HMRC to accept claims given their crackdown on them. What you need to do is clarify the relationship with project managers. Is the subsidiary just claiming for its costs, or the company, and time on the project? Was it claiming for the costs of hiring partners on a project? What you're not allowed to claim in R&D is market research. And it does become difficult to sustain a claim if effectively you've got anything that looks easy or something that is well known within the market, or HMRC would think is well known within the profession. So again, you need to show that you've overcome a technological issue rather than just changing and adopting sensible practices. For R&D, you probably need to focus on the technical side. In any report, you need to have less waffle. Waffle, particularly AI-produced waffle, is not good because HMRC will recognize it. And you may need more technological detail, read the technological challenges and resolutions. In terms of record keeping, a company should keep records about two elements: the specific costs under separate headings, and also the planning of any exercise. So it's a distinct exercise with a goal that was set out at the beginning, how that may have changed through the process, and what the outcome was. And in terms of the planning, you're looking at what the R&D aim of the project is, what advance in science and technology is being sought, a link between the outcome of the R&D project and the effect on the commercial prospects of the company. The report should set out all details in terms of activities that qualify, the methodology and reasoning, and I would say, in order to give it credibility, the activities that they considered but did not qualify. That will give you more credibility. Before submitting the report, try and look at it from an HMRC perspective. What questions does it raise, and can you answer them on a preemptive basis rather than waiting for HMRC to ask you more questions. And the final challenge is it vague? If it's too vague and waffly, HMRC are likely to ask lots of questions. In the conclusion, you don't want the resolution sounding a bit trivial, like you tried a device, it worked, end of story. You need to show how it falls within the HMRC rules, how it complies with HMRC rules. You've got a project, you had a technological challenge which couldn't be easily worked out by a professional working in the field. You had to build a project, you maybe had to change things, and this was the conclusion of the project, and it either achieved something major, and if it did, you quantify that, or if you aborted the project, why you did so and what sunk costs there were. At that point, thank you very much. There are my details if you've got any further questions. Kept you very slightly over time, but thank you very much indeed. And on that basis, I'm happy to, yes, I am doing a spring update. And thank you very much indeed. And I hand back to K3 now.